Welcome to the Valuation Desk by Highland Global, where SBA business valuations speak bank. Thank you for joining us. I want to talk about a topic that generates a surprising amount of controversy in business valuation, especially in the context of SBA 7A lending, and that's tax affecting the income of pass-through entities like S corporations and LLCs when using the income approach. Let me be clear from the outset. This is not just a theoretical debate. The way we handle taxes in our valuation models directly impacts fairness, credibility, and comparability, especially when lenders rely on these valuations to support large financial decisions. Now, as you all know, S corporations and similar entities don't pay income tax at the corporate level. Instead, income passes through to the owners, who pay tax individually. But here's the critical mistake some analysts make. Because the entity doesn't pay taxes, they leave income untaxed in the valuation model, yet they apply market-based discount or capitalization rates that were derived from tax-paying C corporations. This leads to an inflated value, a mismatch between the numerator and the denominator. And that's where things start to go off the rails. Let's break this down. Tax-affecting pass-through income aligns our earnings with the discount rates we use, rates that are based on tax-affected C Corp data. Without this alignment, our value conclusions are inconsistent. It also reflects economic reality. Even though the company doesn't write a check to the IRS, the owners still pay tax on that income. It's not free cash flow if a portion goes to Uncle Sam, whether paid at the entity or individual level. In fact, major experts like Shannon Pratt and Aswath Damodaran support tax affecting when valuing S-Corp under the income approach. Why? Because it reflects how real investors think in after-tax returns. And the courts seem to agree. In Delaware Open Murray v. Kessler, the Chancery Court affirmed that tax-affecting S-Corp income is appropriate for comparability. In Bernier v. Bernier, the Massachusetts Supreme Court ruled that omitting tax-affecting led to an unfair overstatement of value in a divorce context. The key principle? You can't inflate value by ignoring taxes that someone still has to pay. Let's address another misconception that sometimes creeps into these conversations. The idea that S-Corp are worth more just because of their tax status. That's not supported by economic logic. Think about it. Electing S-Corp status doesn't magically generate more revenue, reduce expenses, or change risk. It doesn't alter the business model. And if that tax status were so valuable, wouldn't every business just flip the switch and become an S-Corp? More importantly, the S election is reversible. A hypothetical buyer, the basis for our fair market value assumption, could revoke that status on day one. So are we really going to assign more value for something so easily changed? Valuation is not about tax forms. It's about cash flow, risk, and return. And whether that cash is taxed at the entity or shareholder level, it still reduces the owner's cash flow. How do we handle this tax affecting correctly? First, apply the state corporate income tax rate, usually where the business is physically located, then apply the federal corporate income tax rate, currently 21%, to pre-tax earnings before using a market-based discount or capitalization rate. This reflects the economic burden of taxation in a consistent and comparable way. To sum it up, tax-affecting S-Corp income is not optional if you want to maintain internal consistency in your model. It reflects economic reality, aligns with market-based discount rates, and avoids overstating value. And most importantly, tax status alone should never be the basis for assigning more value. That's a fiction, and one the courts and market participants increasingly reject. As valuation professionals and lenders, we owe it to our clients and to each other to ground our work in both technical accuracy and economic substance. Thanks for joining us for this episode of the Valuation Desk. At Highland Global, we bring decades of hands-on experience to every appraisal we deliver. SBA lenders trust us because we understand what's at stake: accurate, credible valuations that withstand scrutiny and support sound lending decisions. With thousands of reports under our belt, we don't just meet expectations, we help set the standard. Our deep knowledge of SBA requirements, valuation principles, and industry-specific nuances makes us the go-to choice for lenders who demand expertise they can rely on. For more information on valuation-related topics, be sure to visit our website, highlandglobal.com. Lenders know experience matters most.